Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Crillo. Today we have Joseph McCabe. He is an entrepreneur, U.S. Army veteran, and CEO and founder of the Surefire Group. His company partners with real estate firms to provide a suite of services to their clients, including mortgage, insurance, and settlement services. Joseph is also an active real estate investor and a managing partner in multiple home care agencies and assisted living facilities, while being a passive investor in several other asset classes. Joseph, thank you so much for coming on the show today.
Yeah, thanks for having me on, man. I appreciate it.
Awesome. So can I give us a little background on yourself? You've done a lot in real estate, from being on more of the brokerage side, which you're still on, going into what you're in as well as in the investment side. So if you can give us a little background on yourself, both personally and professionally, before investing in real estate and also launching your company now, the Surefire Group.
Sure. Yeah. I was in college in December of 2015, and about 6 months prior to that, I was going to graduate in December. I had a start date with the Philadelphia Police Department. And within that 6 months, I was training a guy at LA Fitness, and he was a realtor in Philly with Long & Foster. And he got me on the typical real estate thing. Join my team, you're going to make $1 billion. And I did. I didn't make $1 billion with him. But that made me realize how much opportunity there was. And in 6 months, I made the police salary. And, I told my dad, and he's a cop, and we're typical Irish Catholic. Everyone's a cop. So I was a cop in the military. I was like, all right, I kind of got that fix. Let me ride out this real estate thing for a little bit. A year later, I had, I kind of got the bug, and I had opened my own RE/MAX franchise because I like to say they were the only franchisor that would take a credit card from a 22-year-old and give him a franchise with no experience and no broker's license at that time. But born and raised in Philly my whole life. 2 years into college at Penn State, I enlisted in the Army. I was going the officer route initially. And then I finished at Cabrini College, which I get to say now is Villanova. So Cabrini College was not as great as Villanova. And then, we really started to just kind of build our own mortgage and title company. And I was great at copying. And so I copied what a Keller Williams did that I was at in Philadelphia, did it really well. And local competitors and national, people started to talk and say, hey, can you do this for us? It was semi-ironic because we were running a RE/MAX franchise, but, the big players didn't see that as competition. They saw it as a value add.
Interesting. So can you tell us a little bit about what your company does on that side? Because it's very interesting. I was reading over your website in preparation for this and a couple of different interviews that you've been on. And it's something I really haven't run into before. And I think back of when I've purchased, let's say, residential housing and how it was structured and how myself as a real estate agent, I don't really use it. I just use it for referrals here and there. But the thing though is that, when I've purchased before and you see how it was usually referrals. Nothing was really done in-house. And maybe this is because I was dealing with smaller brokerages. But if you can just let us know what your firm does and how you're providing value and what you really copied from those large brokerages.
Yeah. And, it's market specific. We're in a lot of markets now where joint ventures don't exist, especially the attorney states like Georgia, Delaware. Now, there's no reason you can't run a title company in those states. It's just traditionally they haven't existed. So in the past couple of years, a few things happened. One, they were always popular in Pennsylvania. And if you didn't have one, it was pretty odd. We knew you weren't making money, so we could pretty easy to get our foot in the door there. But, after COVID, after this interest rate hike, after inflation, the volatility that builders were experiencing, we started to do some research, and we realized, one, out of the top 200 builders, the majority of them, more than 70%, did not have in-house mortgage and title. As a realtor, if you go into a Toll Brothers showroom, you leave your business card, you're getting paid. They're using Toll Brothers mortgage and title company. You don't have a choice, right? As a consumer. So we started building that for builders. And then on the broker side, doing the same thing, because between the NAR settlement, the fact that rates were higher, volumes were down, agents want more commission, want more services for paying less commission somehow. And they want all that to happen. And the brokerages are just left with needing to bring in ancillary income. And the only meaningful ancillary income that you can get is on title and mortgage. The rest of it's kind of BS, transaction management. Some people have these home warranty things you make $25 off of. Like, it's nice as the agent, but for the real estate brokerage itself, for $100 million brokerage, and depending on the state, most of the time the realtor from the buyer representing the buyer controls title, recommends a mortgage company. $100 million worth in buy side volume could be $1 million in profit to that brokerage next year. And it gives them an opportunity to, in most of our structures with realtors, go and say, hey, all right, we're the managing partners, Keystone, State Abstract, or the Surefire Group. There's 49% equity left. Typically, the broker keeps 30% of it, 20% of it goes to their agents. And now you do that for the top 20%, doing 80% of the business. And you've got golden handcuffs and, possibly life-changing money for the broker owner.
Yeah, that's a very important thing, because that was one question I was going to ask you about how the settlement changed. And since you touched on that and how the changes have been, I imagine this is welcomed with open arms at many brokerages, because it's, like you said, another additional income stream, which not all brokerages have. So you're keeping some of the agents kind of locked in there, but also, as people, I don't know the numbers, but most people don't buy more than a few different houses in any lifetime. So by the time they're buying another one 7 years later, let's say 8 years later, as their life changes, they probably forgot everything they did 8 years ago, right? So it's having it all under one roof, so to speak, where it gets passed here, then it gets passed there, then it gets passed there. The cost doesn't really matter, right? It's just a convenience factor.
Yeah, the cost doesn't matter. And when we set up our mortgage companies, we do them as brokerages, right? So everything we do is super regulated. I mean, we're not a retail lender. We can't mark up our rates. Like when we enter into a partnership with these real estate companies or builders, we're not like, a guaranteed rate where it's like, all right, we're going to pay you 1%, but really what we're going to do is mark up the rate by 1% to make up for that. We're still just a broker, right? It's a separately licensed broker shop. We get set up with wholesale lenders and the rates are competitive. And so that's a really big thing, is like, we're not hurting the consumer by doing this in any way. Even title rates in most states, and in some states, your split with the underwriter is regulated. So we're in highly regulated, highly audited businesses that, look, this consumer is going to go somewhere to get this done. And NAR surveyed consumers, and 86% of them want a one-stop shop, right? They want to be able to go to a real estate broker. Like you said, they're going to purchase very few homes. They want to know that their agent can solve everything for them. They don't want to be a professional or passive investor, right? That's not their goal. And frankly, some investors, want that too. They want to just say, hey, I'm deploying, especially the more passive ones. I'm buying this property, you get the inspection done, get mortgage and title done for me. And I'll see you at closing.
Right. Yeah, it makes perfect sense. So the selling proposition is that, you're adding all these value add services to the brokerages and then also to their clients. Now, how do you touched on it before, how do you really find these potential, identify these potential brokerages to partner with? Is it really just sorting them out and mainly going to them and saying, you don't have these services, would you like these services? Because I guess in the past they would just do a referral out, is that correct? And they wouldn't get paid on that. I don't think you can really get, as a real estate agent, get like legally paid on a mortgage, right? There's all that stuff from 2008, right?
Yeah, well, a little bit has changed on that front. So in 2022, and this is just, when you think about like the regulatory landscape and, in my opinion, a lot of the goofy things that happen, like this NAR settlement, it's hurting consumers. And some states are starting to say, this doesn't make any sense. And they're starting to regulate against this NAR lawsuit and the settlement that happened. And just I think it was Alabama that was like, no, you don't have to sign a buyer agency agreement to see a house. That's insane. So, we're starting to see the regulations there. But in 2022, the CFPB removed the dual comp rule. So, in California, and I call it a gimmicky market, every realtor was also a loan officer. And a lot of them still are. But you could only get paid on a conventional loan. So maybe that was attractive in California. But for the rest of the country, 60% of mortgages, maybe more, are government-backed, VA or FHA. So what they actually did was say, look, we're taking that away. So it gave us an opportunity for the broker owners to say, look, you might potentially get to keep your 49% entirely. You don't have to give anything to the agents, because what we're going to do is get them dual licensed as a loan officer. They refer the business to our senior LO. That senior LO closes it, makes sure it's priced right, compliant, all that stuff. And then the realtor just has to maintain their loan officer license. So it's interesting because that changed in 2022, despite all of this additional regulation and this attack on commissions for realtors. So it's pretty interesting to see that happen. And in a lot of these states, I mean, you do see where it's very, very strict as far as what you can accept as a referral, what you can pay for in marketing services. You know, Texas is a state where it just doesn't, you just can't. And there's a crazy case in Washington State where they got fined $10,000, a title company, because the cheeseburgers they gave out should have had somehow been branded for the title company. Really goofy things. But there's one thing that's really clear under RESPA, which is, you know, that document just says there's a safe harbor provision. And as long as you're a shareholder, and this is a true separate standalone title company, standalone mortgage company, it's got its own expenses, its own website, it's a real company with real people running it, a license and all that stuff, then you're really protected. So when we do talk to real estate companies, all the time we hear, oh, we have a JV. And I'm like, well, hold on, let's qualify that. What does that mean to you? They pay us $10,000 a month. Like, yeah, that's not a JV. And that's definitely not what you're paying in rent for that office space. So it's not fair value. And so we try to educate them, and then we show them the numbers, and the numbers typically, speak for themselves. So when we're identifying these partners, we have one entity that we allow individual agents, teams, and small companies into. So this would be anyone sub 100 million in volume, typically at least 10 million in volume. Could be a loan officer, could be a wholesaler, could be an investor that's got, we're looking for a year's worth of business, not like last year I bought 10 million in property. All right, well, we want to see multi-year track records, because once we add you in, you're an owner and you're kind of a sweat equity owner. We're expecting that business, time and time again. Now, for the brokerages and the builders, we're looking for 200 million in buy-side volume to be available. We'll go to 100 million depending on the market. So 200 million is kind of like what we say, but in Texas or Arizona or any escrow state, on top of the generous title premium, you're also getting escrow fees. And then if we can bundle, whenever I say that, I think of bundle home and all that, but if we can bundle mortgage and title with that brokerage, then we might even go a little less, right? Then we might go to 75 million because we're getting paid on both sides of the deal. And then we'll do one or the other. Like, we just partnered with a builder in Tennessee, in Knoxville. We did a mortgage company with him because he already had a title company. And then the inverse in Minnesota and Wisconsin, partnered with a builder there who already had mortgage with a high school friend. And then we did title. But the great thing is, if that relationship falls apart, even if, they've already got a JV, we like to get a pro forma in front of them anyway and just say, look, keep it in your back pocket. We don't charge management fees. It's a true company, a true partnership. We either win together or lose together. And, we put it in front of them anyway. And a lot of our great joint ventures have been people who left their current partnerships.
Interesting. Yeah, that's a fantastic value add service to brokerages, which obviously are under fire from the settlement and the changes, and also the other competitors that are in the market. Not to speak with all the other technology people out there that are, people who might be searching for houses through and not going directly to an MLS listing or to an agent. So very interesting there. Can you moving on to the investment front side of it, because there's a lot of people. You went from brokerage to adding value-add services to brokerage, and then you went to becoming a real estate investor. And you have single-family, multifamily, mixed-use, assisted living facilities in your portfolio. What was the reason? Because most brokers, agents that I've met before, don't go to the investment side, right? They stick on that brokerage side. On that, why make the switch over other than just seeing all the money that was made over there?
I mean, in fact, most never make money. I mean, they a lot of these brokerages that we see, and I'm a RE/MAX franchisee. I see it. These guys don't make any money. We may be very few of the RE/MAX franchisees out there that make money, but it's because of mortgage and title, right? It's not because of the brokerage. And that's a big misconception. You can make a lot of money in sales. You're not going to make a lot of money owning a franchise unless you bolt all these things on. So I think, I've always been good at copying, right? I was going to be a cop. I was in the military. No one in my family has money, just super middle class, average. We don't have any sob stories, but that was us, right? And so when I got into real estate, there was this guy at the gym that I knew, Bob Mazer, and he literally just passed away. But I did everything that guy did because he was kind of the first guy I ever met with money. And so when I got my license, I went to him in the gym and I said, Bob, I got my real estate license, and the typical stupid pitch of like, if you're ever looking to buy, sell, invest. And he's like, I actually, owned 5,000 units at my height. And I was like, wow, had no idea. Didn't even really know what that meant. And he's like, why don't we go get lunch? And we went and got lunch. And he said, look, I'm going to give you a listing of 99 properties. But you got to go sell 25 first, because I don't want you to screw this up. So he had me go sell 25 homes for someone else. He gives me this listing of 99 properties, $13 million listing in Philadelphia, all single family scatter site portfolio. And I would watch him spar with people when it would get close to closing. Like, he would fight for every penny. And we lost like 3 or 4 buyers. And I finally had this idea where I said, Bob, if this might sound crazy, but I would give you the 14 million, but we got to get creative. You would have to seller finance the entire package to me, and then I'll refinance it. You manage it. You keep all the rents. I don't want anything from it. I'll structure the refi and then give you the money. His partner killed that deal, but it lit a fire under me. And I went out there, and my first real estate transaction that I purchased, which I was only about 2 years into real estate. It was probably 2018. Yeah. So about 2 years into real estate, it was 2018. We took down 75 properties in Pittsburgh, and then another 30 in Chicago, and then maybe another 20 in Detroit. And we sold all of those properties kind of at the height. And we sold the Pittsburgh group to BlackRock. They were doing a ton of single family acquisitions. But what I loved about the real estate side of things was, I just copied what Bob did. And single family, I wouldn't say it cash flowed well. But I think the biggest opportunity in real estate is that if you get the right deal, the right property at the right price, you can have appreciation, depreciation. You can take advantage of cost segregation studies. You could have cash flow, but at a minimum, if you can hold that thing long term and it can pay off its own debt and appreciate, you could walk away with a nice chunk of change. And maybe cash flow is not your goal. You don't need any more cash, and maybe that's why you're in real estate to begin with, because you're already a high earner. So I liked it because it kind of touched a lot of different facets. And I was kind of using my operating businesses to bridge the gap to get me into real estate. And, one pet peeve I always had was, especially around that time in real estate, YouTube and real estate channels started to become really popular. And everyone was a freaking wholesaler or real estate investor. And I saw these people that they didn't really have any income. They were basically trying to go from nothing, no sales experience or anything, straight into owning homes, flipping them, renovating them. And they were calling themselves investors. And I was like, the big thing about the guys that actually make a lot of money in real estate is that they're typically deploying money from a strong operating business or a fund or whatever, right? And so a lot of these guys would be short-lived because they tried to shortcut. And so I've always focused on, try to make a great deal. If I can make a great deal, like a seller finance situation, awesome. But my priority has always been grow these operating companies, park that money into real estate that I can do a cost segregation study on and take all the, the tax benefits of it. And I don't focus on cash flow as much as I focus on will it cover itself, and I'm focused on kind of a long-term appreciation.
Yeah. No, that makes perfect sense. That's I did an episode like a year or so back, and it was called like zero down doesn't mean zero money. And I think it's one of those things where, people are it's a whole different thing. Like, if you put anything up there that says zero money down, you'll get like so many clicks on it and so much, but it's just clickbait because it's not the right way of doing it. The right way of doing it is actually building a business. And when you're investing, like you said, back in the real estate, that's where you have people that are like, oh, I'm going to make this much money per month and that. And you don't have reserves, right? You've gotten really high leverage loan to value kind of debt on it. I mean, this is just a recipe for disaster that happens over and over every 10 years in real estate. You know what I mean?
And they've been trained, I got to have cash flow. I got to have cash flow. So, when they lose that tenant or when they, they're only making $100 a month, they go and sell it possibly underwater. And it's like, but that was never the goal, man. Keep that, pay off that debt for 10, 20 years, refi it if rates go down, and just keep it forever. And eventually you'll cash out on $200,000, $300,000, $400,000 and you stay. But a lot of people use it as like, I feel like there's this huge focus on getting out of their day job or getting out of and it's like, dude, you're 20, you're 30. What do you do? What are you doing that for? Like, worry about, I think that's part of my generation is this. I was probably one of the few kids that wasn't traveling the world and backpacking and doing stupid stuff. I jumped right into business in the military and I wanted to learn and make money. A lot of people were more focused on work-life balance, and they never really got the work part down.
Yeah, no, it makes perfect sense. Yeah, it's one of those things where when you're buying properties or you're investing, I think it's, I had this older investor tell me years back, it's like you got to hold it for 10 years. If you can hold your properties for 10 years, you're going to do well. You start getting cute and trying to shortcut that. You can't hold the property for 10 years, whether it's a debt, whether you don't have money for reserves, that's when you're going to lose money. You know what I mean? The surefire way is really 10 years, hold on to it, make sure cash flows, all this kind of stuff, these things, it covers the expenses at least, and it's a wealth generator. Then you're going to look back in 15 years and go, oh my God, the value that nothing I really did, I just managed the property, this business I bought, right? And now it's like worth so much, it's tax deferred. And that's the whole point about it. Then you bought something for $500,000. Then you look at it and you go, wow, this thing's worth like 1.5. You know what I mean? And I was literally just collecting rent on a few units for 10 years. You know what I mean? So that's where the really powerful is. It isn't trying to make $200 a month per unit, which I know people don't want to hear when they're looking for cash flow, but that's the true thing. Building wealth through real estate. Family offices aren't buying real estate to make a couple $100 a unit, right? They're doing it for long-term wealth, for tax advantages, and like when you start following that business model, I feel that's where true wealth comes.
Yeah, that's true. And even in that scenario, right? You buy that $500,000 house, say the neighborhood tanks, but you can still sell it again for $500,000. It wasn't your money, and you didn't pay the interest on it anyway. The people living in it did. So you didn't have $500,000. So if you can wait 10 years, maybe you sell for $500 again, and you free up $300,000 that you never had. And if you were making $70,000 a year, I mean that's a pretty good nest egg. You can sell that in 10 years and park it in some other more passive investment, even more passive investment vehicle like a money market.
Exactly.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carrillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
So, Joseph, let's talk about now about your current investment strategy. You were talking about doing some seller finance deals, getting into that, finding that was a great niche. Can you talk a little bit about what your investment strategy is, the type of properties that you're really focusing on currently?
Yeah, the majority. So once we sold our single family portfolio, the majority of what we own now are buildings that we own or occupy, mostly commercial space. So all of our healthcare companies, we own the buildings that we're in. Typically they have, 2 to 3 units. So it's never like a 1 unit deal, except for one of our real estate buildings we're the sole owner. Frankly, for the past 2 years, I haven't seen a lot of great deals out there. I've seen very, very compressed maybe even more than 2 years, but I've seen these really low cap rates, deals that I wouldn't touch. And I think a lot of these people, you probably see it more than me, but a lot of these people are now getting stuck holding the bag on something they can't refi, and people are starting to hurt a little bit from a valuation perspective. So I guess my biggest thing right now is I'm kind of holding tight. If we don't own or occupy it, if it wasn't something I was going to pay rent on anyway, I've been kind of sitting out. The money that I have been parking, like with our partners that are builders, a lot of them have funds. So I've been partnering with those guys on any new construction, because new construction is just a huge demand. And then I have a couple of friends that are in the multifamily space. They focus on, their full-time job is acquisitions, and they have good deals. So I've been parking it there. My direct investments, though, the things I'm going to buy on my own, I'm waiting. I think we're in a weird, very strange market, and I see it on the real estate side. I mean, I was excited when rates went up, which sounds like, kind of weird for a real estate broker to say, but when rates went up, I finally thought, okay, this is going to fix the affordability problem we have. And whenever I think of the market, I think of the normal guy, and I think of like, okay, my brother's a cop. Can my brother buy a $500,000 house with a wife that doesn't work because she's home taking care of 2 kids? The answer should be no, but people are. And I think they're doing that by draining their entire savings. They're doing that by selling properties that they should just hold. They're really hurting themselves to kind of keep up with this market. And so I was happy because I thought, okay, rates are going to go up. It's going to drive prices down. That did not happen. And now we're at a total standstill. Now rates are up, prices are up, everything's unaffordable in most markets. And I don't know. I think if they lower rates now, I don't think it fixes the price problem. I think it puts more, makes people able to afford these assets, but only because of the rate. And so it's a really strange place to be. But I'm waiting for some type of correction to happen. If that is rates, fine. Maybe I'm a buyer again. But I'm going to be looking for the sellers that made a bad deal when they bought 2-3 years ago at the height. And maybe there's a little blood in the streets, and I'm going to be looking to make a killer deal.
Yeah. I agree totally that we haven't bought a syndication deal since the end of 2022. So, I mean, we're going on, 2+ years with it. We just refinanced a deal that we bought at the beginning of 2022. And I'm going to give you just a couple of things that I've heard, and you can kind of give me your feedback. So I read something like yesterday, 49% of homes are underwater, right? Residential homes are underwater. We just refinanced a deal, like I just said, in 2022. It was one of our complexes about 45 minutes outside of Atlanta. And our mortgage broker at the time, said it was the only deal that he sold or financed or whatever in 2022 that got a cash out refinance. So that's how telling you how tight stuff is, the cash out refinance is supposed to be, we should have done it sooner. That's the whole plan, obviously, because everything happened. We've pushed that back a little bit, but still 3 years into it, we did it. And it's one of those things is that's the business plan for all these deals, right? That's how they can push double-digit returns, is by having the refinance penciled into the pro forma. So that's one of the things happening. And then the other thing is that, like you said before, with the interest rates, I mean, we're pushing so many people into rentals. And how do you see like this turning out over the next few months? Like you said, it might be fixed by rates. But the thing though is that, we just started this year with a decrease, double-digit decrease in new deliveries, which is going to continue 2026, 2027. And that's when every person that I'm in passive investor with that's had issues, they keep on telling me, we're selling in 27. We're selling, okay, well, I don't know what's happening in 27. And they have like a down to the month. I have one group that told me we're selling in July 2027. I go, that's a very exact, all right, we'll see what happens. But what do you think about that?
And the rates are a Band-Aid. Again, it's like, all right, if we drop the rates, I just think like eventually you just have to get to the point where everyone's a millionaire, because everything is still unaffordable. Like I just, and that part drives me a little crazy, is that things have gone, and there's always the neighborhoods, the pockets of wealth that, those are always going to trade for high valuations. But, when a row home in Northeast Philly is appraising for $300,000 and it's 1,000 square feet, it's like, those people can't even buy that house. Like the New Yorkers buy that house, and then they Section 8 it or they hold it as a rental. They think it's a great deal. But then, then you end up becoming New York. So, I don't know the right answer there. I mean, I almost think there needs to be a massive correction. I thought we were getting close there 2 weeks ago. But I feel like something has to happen within the markets to correct these prices, because I think you can lower the rates, but I think you're just band-aiding that bigger issue, which is, this inflationary problem we're seeing. And also too, I mean, it's kind of a double-edged sword for me, because the longer that prices are high, the longer that margins are compressed, the longer that builder costs are high, right? The more these people need our services. But at the same time, I think it's hurting the average person that's just frozen and sitting on the sideline of these markets. And everyone now says the same thing. People that aren't even educated in real estate, it's like, okay, I could sell for, 1.5, but what am I going to buy? And what's my rate going to be? And they're just like, I'll just wait for something to happen.
Yeah. The rate, that's what everybody brings it down to. There are certain things in real estate, like we're talking about your settlement services. When you look at that closing statement, after you say you buy a house and you tell somebody what you bought a house for, the next thing they ask you is about the rate, right? It's not about what did you pay for, what was your title service?
Yep. And most of it's up here. When you really run the math on the rates, like, my brother's an example. He's owns a couple nutrition shops in Jersey. And we talked about it. He's like, hey, I heard rates went down. I want to do a refi. And I said, well, look, I'll certainly look at it for you. And he was at like 8.5%, but bought at the height. So even going to 6.75, I'm like, dude, you're gonna pay all these costs to close the deal, and then you're gonna save $75 a month. So even the rate doesn't impact things as much as the purchase price. And obviously, you hear a lot of sales pitches out there, and realtors and loan officers say things very, very differently. But in reality, when you really run the numbers, I'd rather pay less, and the rate is not going to impact me as much. If we could fix that underlying asset inflation problem, I think rates could happen later.
Yeah, instead of looking for a deal to shave a couple extra basis points there, it's easier just to spend more time in your business and pay down your principal, right? Save that $75 there. But how do you, one of the things that you mentioned, and before we wrap up here, a couple asked our questions. I had somebody on the show before that was talking about triple net leases, and I said before that I thought it was a good idea that people buy their own buildings that they're in. My family had growing up. My family had some family friends that own restaurants. They had like 3 or 4 of them. They bought them. They sold the businesses. They kept the real estate. You said that you own it, mostly owner-occupied commercial properties. And then I've also heard from people, well, it takes away the focus. I mean, if you're triple net lease and you buy the property, you're still managing all that stuff. You still have, right? You know what I mean? So what is your take on buying properties, say maybe I'm talking about small like mixed use properties, owner occupied commercial properties for like offices like you're doing versus somebody renting it? You know what I mean? I mean, where do you see that?
Yeah, I mean, I think like most of the time, when you're renting those office leases anyway, you're pretty much responsible for everything anyway, like a triple net. So you're responsible for the taxes, the insurance. I mean, you might as well take the bulk of that and pay down the principal. And so we own a property now where we're going to sell the business that's inside of it. It's the exact situation you're talking about. And the new owner is signing a lease for $1,000 more, plus taking over the taxes, the insurance on this property, and all of the maintenance. And the roof is brand new. So, at the end of the day, I think that's a great deal. Plus he has to buy we wrote it into the contract that he has to purchase the property from us within a certain time period at a specific price. And that price increases 5% every year. So, we owe $450,000. He's already agreed to 1.3. He just can't do the deal now, or it's going on market. So I think it's a good strategy. And, I think it's a good opportunity to, if you're going to pay $5,500 a month in rent anyway, well, your mortgage is going to be $3,200. And so it's a good opportunity to pay yourself, possibly the same ownership group, and earn that equity back, as opposed to giving it to a landlord. So I'm a huge fan of that. I guess the only reason I wouldn't do that is if, you were unsure of a business model. This specific company that I acquired 5 years ago has been in that building since 1979. It's mostly up to date. So it's kind of an important asset for the business anyway. And also, too, I never want to get kicked out, right? I mean, that building should be there. That is, everyone knows that company and that building has been there across from the Burger King, everyone says, has been there forever, right? So that's important to it anyway. So I guess there's some other things that they got to look at there, some intangibles, but I think it always makes sense to own the real estate. You're going to pay it anyway.
Yeah. No, the lease option is a fantastic idea. I think for people starting a business, purchasing is probably incorrect, but talk to your broker and try to get that lease option put in there, like you're working with it. So they have the option of purchasing it. They have the option of, growing their business through there, whatever it might be, but also they're not locked up if something happens with their business. And I think people say it's one way or the other, and it's no, you can have a little bit of both in between there by structuring. That's what's one thing that's great about real estate is you can really structure the contracts any way you want. I remember my dad years back, his partner was buying a property and they negotiated an old BMW into the contract somehow. So using it as a down payment. So that's the one thing in real estate is you can get very creative in buying real estate and financing it and doing deals. But Joseph, one thing, how do you maintain focus while running multiple businesses? You have, you're owning property, you're planning on buying more property, you own businesses with joint ventures, all this different stuff. How do you do that?
I try to take time to realize I just kind of went through this project now. I let go of a guy who was supposed to be a chief of staff, really wanted to be a COO for us. I let him go, and I realized that he had never really taken tasks off of me that just didn't energize me. I should be focused mostly on shareholder relations, looking for new deals, making sure we have enough capital, hiring great team members, things that drive us forward. And I'm really good at all the other stuff. I can build the operation out, but then I'm not going to be as great on a sales call. And truthfully, I feel drained at the end of the days when we do that. I love to get the quarterly financials for all 60 companies. I will go line by line through the general ledger and make sure that they are all categorized correctly. But if you call me that day, it's going to be a very different tone in my voice. So the way that I maintain focus is through 1, routines, 2, hiring people to take those tasks off my plate. And so thanks to Doge, because this guy worked for Southern Command, he was a fractional CFO for us. I brought him in as our full-time CFO, but mostly chief of staff. And I said, look, these are the things that frankly I hate and you love them and you do them. And obviously I don't, some people worry they lose power over those things. I mean, you're still the owner of the company. I can do whatever the hell I want, but I want someone else to do that stuff who's better than me, who likes it, who's energized by it. And I can focus on the things that drive the business so that we don't ever hit any speed bumps. And it's all about the teams that you have. And then those routines. I mean, I struggle with this sometimes because I'm in a group with called R360. And a lot of the guys that are in this group, even highly, highly successful, the average family net worth in this group is like 400 million. And even some of these people fall out of their routines. They'll ask all the time, well, how do you stay motivated to go to the gym every day? I'm like, I'm not. I just go. I just go to the gym every day because it's a non-negotiable. Just like waking up, getting my coffee at Starbucks and working is a non-negotiable, right? I mean, so I guess sometimes you're not going to be motivated. You're not going to be focused, but that's where if you have that routine and you are in a rut and you can stick to that and, you'll be all right. And then sometimes it's just, I forget who says this, but, sometimes it's okay that, your routine breaks and you lose focus for a day, but just get back into it the next day. And get back as quick as you can. I think people just kind of get discouraged, sit on the sidelines and think they can't fix it. And it's like, no, man, just do the same thing you did when everything was working, right? Just try to remember. The worst thing I ever hear from team members is they'll call and complain about an employee. And I'm like, well, what did you do at your previous company? We did this, this, and this. I'm like, well, why aren't you doing that? They're like, oh, that's a good idea. I'm like, no, it's not. You're thinking too much here. What works already. Do it again. Don't think you need to do something different.
Interesting. One last question before we get information on how to reach your company. What leadership advice would you give to someone looking to grow a business or a team?
Well, I would say that, again, the biggest thing about that is, save all of the money that you can in the business. Like, so many people start a business and immediately think now they've got to have the BMW and the Rolex. I told a guy, someone told me, one of my realtors, that people would take me more serious if I had a Rolex. This guy's never owned a company. And so I was like, so be careful who you're taking your advice from. The worst thing as a realtor, right, is when Uncle Joe, who rents, shows up at the home inspection. That guy's never owned a house, and now he's going to advise your client that this house is beat to death. So I always say, just be extremely careful about who you're taking advice from. And if you wouldn't trade places with those people, then you probably shouldn't be taking their advice. And the other thing is, give the business room to breathe. Like, keep the money in the business, reinvest in your business. Don't be afraid to hire people and delegate those tasks away from you. And yeah, there's going to be, and nothing's ever below you, by the way. I mean, if the trash is full, take it out, but make sure there is someone to take out the trash, and make sure that, every day, you're not going to have work-life balance. If you're going to start a new company and your goal is to build something actually meaningful and big, and you're also going to try to find work-life balance at that same time, you're not going to have it. You're going to have work-life choices, and you're going to have to make choices, and that might mean that you miss things on what you might call the balance side, right? That might mean that you don't get to hang out with friends as much, or you don't get to spend as much time with your family. But that's how it's going to be. I mean, you can't read a single biography of any person, whether it was a general politician or a business owner, that doesn't talk about how, hey, I missed these things, and I wish I had gotten to spend more time with my kids. And you can find some sweet spots there, but I think you have to be willing to go all in, and that balance is going to come with time, and that balance is going to come with, that time where you look at the bank account, you take a deep breath and you feel calm, and you're like, all right, I can hire people to do some of these things I don't like to do now, and I can spend more time with my family. But I think people go into the business thinking they're going to find that up front. That, I think, is a huge mistake.
Yeah, no, that's great advice. It's one of those things where I had mentors tell me, it's like, you have to get the business to X amount to actually bring in like a really good manager, someone else that you can really delegate to, not just like assistants that you can pass stuff to, which is like in the beginning, right? You get your bookkeeper, assistant here taking stuff off, and you're saving an hour here, hour there, and it's fantastic, right? You get a little bit of your life back. But once you like hire someone that's like high level that can come in, that's like really the goal. And once you do that, that's when you can start kind of having a little bit more of that balance. But you got to get the business at that point sustainably. You know what I mean? That's kind of what I found. So how can listeners learn more about you and your business, Joseph?
So they can go to the surefiregroup.com. So if they're interested in any of the title or mortgage joint ventures that we have, or even if they just want to try us out and see if we're licensed in a state where they need, title work. Most of our mortgage stuff is residential. We're not a big commercial shop. But they can go to the surefiregroup.com, homefrontloans.com, or, if you do have any direct questions, feel free to shoot me an email, joe@thesurefiregroup.com.
Okay. Joseph, thank you so much for coming on today. We'll put all those links into the show notes, and looking forward to connecting with you here in the near future.
Awesome. Yeah, thanks, man. Appreciate it.
Thank you.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.